We've got Gautam Samarth, who is joining us from London to talk more about how markets are reading those macro developments. Gautam, good morning there in London.
Good
It's
morning.
cold and rainy. I was there last week. Good weather, interesting weather, but the weather in the global market is also pretty interesting. There are 3 central bank meets this week. Do you expect anything material coming out from anywhere, Fed in particular?
Um, Thanks, Ajay, and yes, I feel your pain. We live the bad weather over here, and we live the fact that the cricket team over here is not going to be making much progress on your end. So it's tough times all around. When it comes to the markets now, yeah, you're right. So the Fed meets on Wednesday over here. I think in uh, their intentions have been pretty well projected in speeches leading up to the blackout period. So the broad expectation is that the Fed's going to be keeping rate hikes on hold and staying in that sort of cautious mode in terms of watching how things progress. The data in the US has been surprisingly strong. The economy has been robust. The third quarter GDP grew at 4.9%, and inflation has been coming down, but it's been a little more bothersome. So it's still been coming down at a slower pace than most people have expected, and the Fed's watching that very carefully. When you take the whole body of what's going on there, it seems pretty likely that they'll carry on with that particular pause. And then if you think about what markets have been doing over the past sort of 3 months, they've recalibrated what their expectation of Fed cutting cycle. So, starting the year, the markets expected the Fed to raise rates a little bit and then start cutting rates by the middle of this year, and we'd be into a rate cutting cycle. Now they've expanded out that horizon of how long rates are going to stay higher. And as a consequence, we've seen bond yields rise and equity markets fell off since sort of the back end of the summer, since July, which has caused some turbulence in markets, but in our opinion, also some sort of tactical opportunities to start adding to risk assets, both in the long end of the bond space, but also increasingly in equities now.
Gautam, what are your thoughts on equity as an asset class? Because I was observing 2 data points. One, gold is also retreated after a good rally. And same is the case with crude oil. And, these two, both crude and gold, are seen as the insiders of geopolitical environment, right? So is it an indicator that geopolitical environment is in a ease-off mode? Or do you think one can't say conclusively yet that things are easing? These two started rallying the moment Hamas-Israel issue was spreading. What are your thoughts there?
Yeah, so I mean that's a very good point you make. The sort of the focus on geopolitics, or the refocus on geopolitics, we've been focusing on it for the better part of on and off for the better part of a couple of years now. There's just a reminder of the sort of exogenous risks that are present in the marketplace right now. And so, as you point out, gold has actually been selling off and had this rally, and so, but it's broadly at levels that you saw in through much of this year, going back to April. But you're right. There's a bit of a safety bid in gold over there. I'd say, and the oil markets also sort of the levels are more or less where we've been for the last year. So we've had a bit of a move and then a bit of a pullback. But more broadly speaking, the market seems to be, at least for now, saying that what we're seeing in the Middle East will be relatively contained. That has the potential to spill over. We know that markets tend to not worry about things until they do, and when they do, they tend to panic pretty aggressively. And all of this suggests that the risk premium that's been built up into assets for the revaluation, equity markets have sort of fallen over about 10% over the last 3 months, and bond yields have risen about 100 basis points, causing about a 10% damage in that asset class as well. So there's been a re-establishment of what we call risk premium or valuation in some of these risk assets, which ultimately suggests the market's being pretty sanguine about spillover in geopolitics or indeed other risks that are on the horizon. And these tend to be opportunities. We've seen something similar in terms of the backup in interest rates and the fall in equity markets in September, October of last year, that turned out to be a pretty good entry point to move into financial assets. This might be something similar.
Gautam, so broadly, the view now emerging is that by mid next year, we may actually start seeing a cut as far as the US environment is concerned, and then rest of Asia and the world may also follow. And we've already seen global markets come down by 15-20% depending on which market are we talking about. Do you think that will pay out, that script could actually be positive for equities as an asset class mid next year onward?
Yeah, I mean, it's interesting. So that expectation of rate cuts in mid of last year was actually supposed to be mid of this year. So it's been pushed out quite a bit. The reality is those expectations are being formed based on what the Fed is saying, more or less. And realistically, when you listen to what Jay Powell was saying in some of his speeches, he has absolutely no idea. The economy has proved very robust with the rate hikes that they've already put in place. But we also know that monetary policy works with lags, and those lags have been very difficult to predict. Indeed, if we look at the current earnings season in the US, it's been as strong as we've had in terms of corporate earnings delivery, in terms of profit margins in the US. But there are some canaries in the coal mine. So you're looking at forward guidance, and companies are starting to say that the outlook is deteriorating. So if some of what's already put in place is indeed starting to bite, and we're seeing that in the housing sector, we're seeing that in the corporate real estate sector, if that is indeed starting to bite, then you could in fact have those rate hikes coming, or those rate cuts coming much sooner than summer of next year. So it really is a function of what's been put in place, how quickly it bites. And if that starts to come down, I don't think the Fed's got a mandate to push unemployment up to 6, 7, 8% in order to get inflation under control. So those cuts could come a lot sooner.
All right, Gautam, we'll let you go on that one. Thanks so much for your time this afternoon.
Appreciate it. Thanks for having me.
Thank you very much. Let's take a short break on that.